We continue with video 3 of IFRS 5, non-current assets held for sale. We are looking at a question which came in one of the past papers. So we are looking at the application. So you do your application by explaining briefly what the standard requires you to do. Remember what we've said before, that you won't earn the good marks if you simply go and address the application. You need to explain the standard in the context of the area that is being tested. So we explain here that in accordance with IFRS 5, all non-current assets held for sale should be measured at the lower of its carrying amount and the fair value less cost of sale, which was the first thing that we observed. Then we also said immediately before classification of the asset as held for sale, the entity must recognize an impairment loss in accordance with the applicable standard. Then you explain the impairment loss, how the impairment loss is treated, whether you are looking at IAS 16 or IFRS 38, intangible assets. Then we said once the asset has been classified as held for sale, any impairment losses will be based on the difference between the adjusted carrying amount and the fair value less cost to sell, and the impairment loss will be recognized in profit and loss if there's any subsequent impairment losses. Then we also said any subsequent increase in fair value less cost to sell may be recognized in profit and loss only to the extent of any impairment previously recognized, the same as what we do under IAS 16. So once you've brought out the standards, then you go to the application now, which we start with our step 1 there. So we need the carrying amount of this asset. We know that IAS 16 requires us to measure an asset at cost. Cost less depreciation gives us the carrying amount. How much is the depreciation, or how many years so far have passed from the time we acquired this asset? How many years? 2 years have passed. Everybody agreed? You acquired on 1st June and you're told depreciation is 500,000 per year. Currently there's depreciation of 1 million. On May 20x3. Okay, so up to May X3 is 2 years, hence 1 million depreciation. Then we move to November, compute the depreciation to November. Before we even look at the November, the question tells us there's an impairment. there's an impairment of 250. The 350, yeah, which resulted in the property being valued at its value in use. So we need to compute that. Which is this calculation here. 5 million minus the depreciation of 1 million minus the impairment of 350. Subtract that, how much do you get before you divide by the 8 years? How much? So 3,650. But why are we dividing with 8 years? Why are we dividing with 8 years? What was the life of the asset?
8 years are the ones which, out of the 10 years.
The asset was 10 years when we acquired it. I-16, when an asset is impaired, you now depreciate it over the remaining life. So it was depreciated, it was impaired after 2 years, so now depreciate it over the remaining life, which is 8 years. But we only need how many months? 4 months from October.
Mr. Crispin, where's the 4/12 coming from?
So the 4 months is coming from June, the beginning of the year, to 1st October, the date on which it was proposed to move to a new premises, and the property was reclassified as held for sale. We said, upon reclassification, what do you need to do? You need the carrying amount on that date to compare the carrying amount with the fair value less cost to sell. So that's what we are doing here. We're computing the carrying amount at the date of reclassification, so that amount we compare it with the carrying amount. So the carrying amount is 3.5. The 3.5, we compare it, the question has given us the carrying amount as 3.4. So is there a gain or is there an impairment? There's an impairment of 1 million, which is our step 2. 3.4 minus 3.5 gives us the fair value is lower than the carrying amount, so we've got an impairment of 1 million. Sorry, 100.
100.
Impairment of 100,000.
By 100,000.
We move to step 3. So we move to step 3. Determine fair value less cost to sell at the date of the interim financial statements, which is 1st November. Are we given, or we need to compute that? The question has given us at 1st December X3 property markets had improved and the fair value less cost to sell was reassessed at 3.52 million, and at the end of the year 30. No. So now we need the date of so on the date of reclassification 1st December, the fair value is 3.52. We compare that with the carrying amount of 3.4. Remember the 3.4 coming from step 2. The asset has gained by 120. This gain of 120, we'll compare it, we'll write it off first with the impairment, the cumulative impairment. We had the 350 impairment before reclassification, and then we had a 150 impairment. No, the 150 was not impairment, the 150 was depreciation. So there's only 350 impairment. Oh, there was an impairment of 100,000.
Which 150 was depreciation?
We have the 350 first, the one given in the question, then the 100 computed,
Yes.
computed in note 2 to give us total cumulative impairment of 450.
450, yes.
Right? So that impairment of 450, we've got a gain of 120, so we'll write off 450 minus 120. So the 120 will be credited to profit or loss to reduce the impairment, and then the property will be carried at 3.52 on reclassification. Clear so far?
Yes.
Then we move to
So what happens if that... Sorry, Mr. Crispin, what happens if the gain is more than the impairment loss?
you only reversed up to the extent of the impairment loss, the way you do under I-16. Where do you take the gain under I-16?
What's your...
Okay, so that's what you do.
So you take the... Sorry, you said you take the what?
You take
You
the
take
loss,
the difference.
the loss to the extent of the impairment, the cumulative impairment you write back the impairment to P&L.
Would it be correct to say that if the gain was more than the 450, you would just take the difference to OCI?
Which difference?
The difference between the 450 and the gain.
You still need to take the 450 to P&L.
Okay.
The 450 still needs to go to P&L if the gain was more than 450.
So the gain is not already in P&L as a result of the loss. Like that impairment loss originally was a TIT expense to the P&L.
But a gain and the loss are different. An impairment you debit P&L, a gain you credit P&L.
Yes. So my question was, if you have a gain of say 550,
but Mwanga, we've answered your question. If you've got a gain of 550, you're going to take 450 as a gain. You're going to write off the impairment 450 in the P&L. You only write off.
so you recognize the impairment. All right.
You write off the impairment to the extent of the cumulative impairments. You had debited P&L with impairment of 450, so you'd credit profit and loss with 450.
Okay. And then you pass the gain.
I asked you earlier on, how do you treat the gain?
Yes. So
When
I'm
an
asking
asset-
to say, if you have a gain, do you then credit your P&L with the 450 and then pass that gain now to OCI? Is that the correct way of doing it?
That's the correct way of doing it, Mangala. That's what I said earlier on. I don't understand how you didn't get me.
No, you are breaking, but now I got you.
Okay. You need to revisit your IS-16 because we did this in IS-16. This working, you find it in IS-16, so it shows you need to revisit that area. We move to step 4, which is now the end of the year. The carrying amount is 3.52 million. The fair value at the end of the year is 3.95, meaning there is an additional gain. How much is the gain?
The 430.
430. How much impairment is still outstanding? Initially the impairment was 450. We wrote off 120, so the impairment remaining is 330. Clear? Is it clear? So the gain of 430 will be restricted to the cumulative brought forward impairment loss of 330. So our entry for the 330 will be to debit the PPE 330 and credit P&L 330. So the asset now will be carried at 3.85, which is 3.52 plus 330 to give us 3.85. Then finally on 5th June, the property is sold for 4 million. So our gain will now be computed as follows: 4 million minus the carrying amount of 3.85 to give us a gain of 1.50. We have done IS 10 events after the reporting date. This asset was reclassified as held for sale before the year end, but the sale only took place after the year end 5 days later on 5th June. So this is, you need to bring in the IS 10 events after the reporting period. If it is material, the sale would be what? A non-adjusting event. Which will be what? Which will be disclosed in the notes. Is that clear? So that brings us to the end of this session on IFRS 5. Please review those areas which we've identified as missing. Review IS 16, review the impairment standard on the treatment of impairment, then review this standard once more. Thank you. We'll catch you later in the next session.